Debt market update, January 2023. GSEC yields traded in a range during January 2023 and 10-year GSEC yield ended the month flat vis-a-vis December 2022. However, the short-end yields rose marginally, thereby further flattening the curve. The movement in yields were driven by soft CPI print, lower than expected US CPI, range-bound oil prices, rising expectations of central banks being close to end of rate hiking cycle, fall in US yields, etc. Corporate bond spreads over GSEC widened on back of increase in corporate bond supply. Average interbank liquidity declined in January 2023 compared to last month as currency in circulation increased. However, net purchase of US dollars by RBI lessened the drag on liquidity. FPI's market activities remained muted and net inflows, including voluntary retention route into debt, was $0.3 billion in January 2023. Cumulatively, FPIs have sold debt worth $0.1 billion in 10 MFY23, vis-a-vis being net buyer of $3.5 billion during the same period last year. On 8 February 2022, RBI's Monetary Policy Committee raised the policy repo rate by 25 basis points to 6.5% and kept the policy stance unchanged with a majority of 4-2. With this rate hike, RBI, in aggregate, has raised the repo rate by 250 basis points since May 2022. Outlook. Over the past few months, the Indian 10-year GSEC yield has moved within a narrow range despite significant volatility in global bond yields, rise in domestic policy rates, and external sector risks. Majority of these factors have started to ease and consensus is that these are likely to continue moderating in the near term. Moreover, there is increasing consensus that major central banks, including US Fed and RBI, are nearing the peak of rate hiking cycle driven by significant tightening in 2022 and softening inflation and growth outlook. Besides, the real policy rate on one-year forward CPI forecast is about 100 basis points. The announced budgeted market borrowings for FY24 were in line with market expectations and alleviated concerns on GSEC supply. All the aforesaid factors are likely to bode well for the fixed income outlook. Key risks to yields falling include elevated core CPI, resilient domestic growth and continued global monetary tightening, heightened geopolitical risks, elevated oil prices, excess SLR holdings of banks, tight liquidity and robust credit demand are also other important factors which can keep the yields at elevated levels. The rise in supply of state development loans might also limit the fall in yields. On an overall basis, in our view, yields are likely to trade in a range with a downward bias. While we continue to recommend investments into short to medium duration debt funds post FY24 budget and MPC meeting, investors may consider higher allocation to longer duration funds in a staggered manner, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.